The market is currently closed, and the last reported close for SoFi Technologies Inc. SoFi was $27.78 per share on December 8, 2025, which reflected a significant downturn of -$1.82, or a 6.15% drop from its previous close. This price action, an immediate and sharp reaction following the announcement of a massive common stock offering, is the central tension point defining the stock right now. It is a classic expectation versus reality mismatch. The general market narrative for SoFi has been one of exceptional growth, a strong push towards sustained GAAP profitability, and a burgeoning financial services ecosystem. Investors were ready to celebrate a fintech success story that was finally executing on its long-term vision. The reality, however, is that an unexpected $1.5 billion stock offering, diluting existing shareholders by over 50 million shares, priced at $27.50, immediately undercut that narrative. The immediate takeaway, the insight you did not anticipate, is that the company chose to shore up capital now, when the stock price is relatively high and the momentum is bullish, rather than waiting, suggesting a possible strategic pivot toward accelerating growth or securing capital for regulatory buffers that investors are still trying to fully interpret. This move isn't merely about raising capital for generic needs. It speaks to a deep, deliberate financial engineering strategy at the executive level that prioritizes long-term institutional strength and aggressive future lending capacity over short-term stock price optics. The market's knee-jerk reaction of selling off on dilution is understandable, but the deeper question is what this capital is truly being secured for, and whether the potential for accelerated, fortified growth outweighs the temporary pain of dilution. The consensus expectation was built upon the back of a truly stellar third quarter for 2025, where the company reported record GAAP net revenue of $962 million and, more importantly, diluted earnings per share of $0.11, smashing analyst expectations and demonstrating consistent GAAP profitability for the 8th consecutive quarter. The underlying metrics were equally impressive. Member growth was up 35% year-over-year, total products grew by 36%, and the financial services and technology platform combined to generate over $500 million in revenue, which is a key milestone in diversifying away from reliance on their lending segment. That growth story of a full-stack digital bank successfully cross-selling multiple products to its expanding member base is why the stock had been performing so well, with a year-to-date return that had pushed past 100%. The general belief was that SoFi was on a clear, unobstructed glide path to becoming a dominant national digital finance institution. However, the subsequent capital raise at a price point below the recent high challenges that simplicity. The sudden influx of shares into the market created immediate selling pressure and a very real fear of shareholder value being diluted, forcing a re-evaluation of the stock's near-term fair value. The institutional money that had been flowing in, recognizing the profitability turning point, suddenly paused, turning a momentum-driven stock into a value versus growth debate overnight. The substantial trading volume on the day of the offering announcement, well over 100 million shares, underscores the scale of the distribution and the panic among some retail holders who had been riding the stock's impressive run-up. This is where the contrarian take emerges. If the company truly believed its stock was significantly undervalued, a debt offering or a smaller, more targeted raise might have been considered. The fact that they chose a large common stock issuance suggests an urgency to monetize the current elevated market valuation to fund a large capital-intensive future initiative, perhaps securing dry powder for a strategic acquisition or significantly accelerating loan originations to lock in market share while competitors face higher funding costs. Drilling into the recent stock movement, the dilution shock has created a significant technical pullback from the high $29, bringing it down to a critical support level around the $27.50 offering price. The battle for this price point will define the next few weeks of trading. If the stock stabilizes and starts to climb back, it signals that the market has digested the dilution and is focused once again on the company's underlying execution and growth trajectory. However, a break below this level could trigger a more severe technical sell-off, as traders see a failed retest of support. Institutional activity, which has generally been net positive with institutions like Vanguard and BlackRock holding massive long positions, will be closely watched in their next 13F filings. The key is whether new institutional buyers step in to absorb the offered shares, or if the distribution is primarily picked up by existing holders looking to average down. The stock's beta, a measure of its volatility relative to the market, has historically been high, and this episode proves that it can experience swift, violent price swings on material news, which is typical for a high-growth, high-speculation stock with a relatively short trading history since its public offering. The macro environment, particularly the interest rate outlook, remains a secondary but important pressure point. As a bank, SoFi benefits from a steeper yield curve, and any signal from the Federal Reserve regarding the potential timing of rate cuts could significantly affect the profitability of its lending segment, which still represents a substantial portion of its revenue. Now we must address the undercurrent that is always present in highly discussed stocks, the short-selling community. SoFi has consistently been a target, and the latest data shows a short interest of approximately 116 million shares, representing around 9.8% of the free float. While a single-digit percentage short interest might seem manageable, the critical metric is the days to cover, which stands at a low 1.82 days. This means that if the short sellers wanted to cover their positions, they would only need about 2 days of average trading volume to do so. This low figure suggests that while short pressure is present, the immediate risk of a massive short squeeze from current levels is relatively low, unless a major unanticipated positive catalyst emerges. The short borrow rate is also very low, around 0.29%, which indicates that the stock is easy and cheap to borrow for shorting, further decreasing the likelihood of a squeeze being triggered by rising costs for short sellers. Short-selling firms, including large players who often file put positions, likely saw the rapid stock appreciation and the relatively high valuation metrics with a P/E ratio over 50 in the TTM as an opportune time to establish short positions, arguing that much of the future growth was already priced in. Their thesis would have been validated by the dilution event, as the stock price dropped exactly as they would have anticipated, a move to raise capital at a high valuation to de-risk the balance sheet, which temporarily puts a lid on further appreciation. Actionable insight for retail investors here is to monitor the daily short volume, which has been elevated in recent days, and the fail-to-deliver data for any significant spikes, although the most recent figures show only minor FTD numbers, indicating market plumbing is currently functioning smoothly. Do you think the high short interest is a sign of smart institutional money pushing for a correction, or is it simply a reflection of the high volatility inherent in the fintech sector? Comment below with your thoughts on the short side's motivation. For those less familiar with the business, SoFi Technologies operates as a one-stop shop digital financial services firm. It uniquely holds a national bank charter, which is a key competitive differentiator, allowing it to take deposits directly and use them to fund its loans, dramatically lowering its cost of capital compared to other non-bank fintech lenders. The business is segmented into three parts: lending, personal loans, student loan refinancing, home loans, technology platform, Galileo, which powers over 100 traditional and fintech companies with core banking and payment infrastructure, and Technesis, a modern core banking platform. The goal is cross-pollination, acquiring a member with a simple product like a checking account and then migrating them to higher margin products like personal loans or credit cards. The older reports and past performance were characterized by heavy losses as the company poured capital into marketing, technology infrastructure, and acquiring the bank charter. That past is contrasted sharply by the most recent Q3 2025 report, which signaled the true turning point into consistent GAAP profitability, the metric the street demanded. This profitability shift is the single most important reality that counters the historical expectation of a perpetually unprofitable growth company. The company is successfully executing its financial institution of